Common mistakes to avoid when looking to purchase a house. So in this video, I'm going to discuss some recent mistakes that buyers are continuing to make, or potential buyers are continuing to make when purchasing a home. The number one thing is currently there is a program called Klarna Affirm. Those are two programs that let you do buy now, pay later. And what happens is when an underwriter takes a look at your bank statements, and when we take a look at your bank statements, we see that you have monthly reoccurring debt that goes out even though it's not showing on your credit report. That is a huge no-no. Never, ever utilize those programs while you're in the process of purchasing a home, or let your lender know that you have those debts so we can advise you on how to potentially get around those issues. Number two, do not co-sign for anyone when purchasing a car. If you are a co-signer or joint on a automobile loan for your husband and wife, that is fine. I would even consider not co-signing for them either if you guys are in the market to purchase a home, because that goes into your debt to income ratio. It doesn't go in twice, but it does affect you. So I would wait for that until after you've purchased the house. Now, in terms of, and I'm probably going to get a lot of feedback in the comments, but this is some issues I see. Co-signing or buying a car for one of your children. If they're an adult or not an adult, I would strongly consider if they're an adult, I would strongly consider educating them on the importance of having good credit or establishing credit so they could buy a car. If it is a minor or a teenager and you're looking to purchase them a car, and you're also looking to purchase a home within, let's say, the next 5 years, you're going to want to probably buy a cash car so that does not count into your debt to income ratio. So in this scenario, even if you're not making the payment on that vehicle and the other person is, that will potentially count into your debt to income ratio. Meaning if there's a $500 car payment and your son or daughter are making the payments, and the payments are going directly towards you, we have to count that into your debt to income ratio. If they are making payments and they're making them directly, we need a 12-month history of them making payments on that car from an account that you're not attached to. Number three, stop listening to people who do not own a home. That is one of the largest deterrents of people becoming homeowners, because they second guess the decisions they make without seeking proper and professional counsel. Number four, another common mistake that people make when purchasing a home is not understanding what's included in a mortgage payment, and that your mortgage payment can increase. Let me expound. If you're doing a 30-year fixed mortgage, your mortgage payment, your principal and interest does not change. So if your interest rate is currently 6%, your interest rate does not change, and that portion of your monthly payment does not change. However, it could be within a year or two. It just all depends on the cycle of the market. Your homeowner's insurance can potentially increase depending on insurance company you're with, as well as property taxes. So something you need to understand about property taxes. Property taxes typically are higher in more affluent areas, better school districts, which is where people want to be at most of the time when they purchase. Lately they've been reassessing taxes over the course of a year. The property taxes are increasing, whether it's the school tax or the actual property tax are increasing. What you want to understand is that your mortgage payment will increase. It will increase over the course of time for those two things, property taxes and homeowners insurance. Now with property taxes, there's not a whole lot you can do. Maybe dispute the value of your home or the assessment of your home, which takes some time and a little bit of effort. In terms of getting a lower homeowner's quote, you may want to shop around your homeowner's insurance policy to different insurance companies to see if they can give you a better rate. But don't always go with the lowest rate. You want to make sure everything in your home that you need is covered and that you can get what you need if something, your money back out if something were to happen to your home. A common mistake number 5 is not vetting your real estate professional. When you are looking to purchase a home, you want to make sure you have a real estate professional who is also knowledgeable with negotiating sales contracts and have experience. Now, I'm all for people getting into the real estate industry, as well as, seeing what they can do as a realtor. However, you want to make sure that if they don't have experience, they have someone who has experience that can help guide them and you through the process. Common mistake number 6, not vetting your loan officer. Now, a lot of times when people come to me as a loan officer, they're looking to figure out how they can look to save on their mortgage, on their monthly mortgage payment, as well as saving money bringing to closing. So most people think that the lowest interest rate is the telltale signs of the lower mortgage payment. It has an effect on how much you pay on a monthly basis, but if you don't shop homeowners insurance, if you don't shop homeowners insurance, that right there can make up the difference in what you pay for your mortgage payment, as well as not having a knowledgeable lender could affect your ability to get pre-approved or them referring you to a knowledgeable realtor. So having a knowledgeable team is one of the biggest mistakes. You can't always go for the cheapest price because that does not always equate to great service or getting lower payment. And a common mistake that most home buyers make is saying they're going to wait until rates drop. Another common mistake that people make when potentially becoming a homeowner is giving up too soon and thinking it's just easier to rent. In the current climate that we're in, most landlords are looking for 660 to 680 credit scores and 3 times the amount of the rental payments. Meaning if rent is $1,500 a month and you need to make 3 times that amount, that means you need to make $4,500 a month in order to qualify. At $4,500 a month, that is an yearly income around $5,400, which the average American actually makes about $54,000 a year. Now, with renting, you need to have your first month's rent and a security deposit, as well as sometimes having to have a second month of security deposit available. With all of that being said, on a $1,500 monthly mortgage payment, that is $4,500 that you need to bring to the table. Let's look at purchasing a home where if you buy a $200,000 house using conventional financing with a 3% down payment, that is $6,000 that you would have to have as a down payment on the home. So that's a difference of a $1,500 payment, which you could make up in the savings you would have as a homeowner at the end of the year with tax breaks. Hopefully you will take these tips that I provided to help you in your home ownership journey. Have any questions pertaining to home ownership, you can definitely comment below, or the link will be below for you to schedule a consultation with me. And if you're new to the channel, do me a huge favor and hit the subscribe button and give us a thumbs up. I'm Kevin Jefferson, the People's Lender. Thank you and have a great day.